the abolition of indexation benefit for fixed income investor is causing heartburn. How to deal with it? There are ways and means you can deal with it, and deal with it very smartly.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, ever since the debt funds lost the tax benefit that they enjoyed, there has been anxiety, chaos among investors, and we have been bombarded with questions. There are a lot of questions that we are getting here. So today in this episode, we'll try to answer some of the most asked questions. Welcome, Dhirendra.
Thank you.
Now, the first question that I want to ask you is, should investors pull out their money from debt funds because of what has happened?
Not at all. And I'll tell you why. Multiple reasons. One is that mutual fund still remains an attractive vehicle if you are investing for the long term. And if you are a long-term investor in a debt fund, which means that you don't want to take chance and you want to hold it, your return will come down, because whatever you will earn, you will not have the indexation benefit. So bad luck. This is unfortunate. But if you are already invested, not to worry, because you will be getting the benefit. The government has grandfathered all the investment that you have made till 31st of March is tax sheltered. You will be eligible for indexation. You will get that benefit. New money that will be invested from 1st of April will not be eligible for that. Okay. So this is, if you are already invested, don't bother. This has not hurt you. But even otherwise, I feel that there is too much being talked about debt fund, that indexation was a huge benefit. You are paying taxes only on the amount which was over and above the inflation, and that is the right thing. But at the same time, I think individual investors still have options. You can still have your public provident fund account. The interest from that is not only, there's no need for indexation because all the interest income is tax free. Likewise, employee provident fund is substantially fixed income, and income is tax free. So in that sense, where individual investors invest, where their money actually lands in a default manner, that is still sheltered. And also when I think of do you have a choice, the choice is fixed deposit, and that is not an attractive choice. Fixed deposit has always been taxable, and this will also be taxable. Can you generate little better return from these bond funds? Yes. So given the choice, bond funds still remain attractive, but if your money is already invested, you don't have to worry.
So one thing, people should not pull out of them at this point of time. Secondly, should they still consider investing in them?
Absolutely. I'll tell you, you should ask this fundamental question that should you invest in fixed income? Leave aside bank or bank deposit or fixed income fund or public provident fund or anything else. If you need fixed income, you need fixed income for two things. You need fixed income to bring down the overall, to improve the stability of your portfolio. You can't be 100% into equity, because when market collapses, it is very unnerving. So if you have fixed income allocation, it provides stability. You are assured that this part of my money is not less risky, it does not collapse. Debt funds also go down, but they go down by 1%, 2%. They don't go down by 30%. They don't crash. So to provide stability to your overall portfolio, you need fixed income.
Right.
And that should be the long term. Every investor must have fixed income. Now, which form of fixed income? If you have public provident fund, keep it. If you need your money, if you have some accumulation or any kind of money, which is not meant for long term, which you might need, you have kept that money as an emergency money, or you have kept that money for putting a down payment for buying a house, and that money should be available on demand at will. That money should be in fixed income always, and that kind of money should not, you would not be benefiting from indexation because it was not to be held for 3 years, and you will not be benefiting from indexation now. To optimize or improve your return, you should still have fixed income fund. It is less attractive, but it still remains the best alternative.
Alright, now another question that a lot of people want to know the answer to is, how about using an arbitrage or equity savings fund as an alternative to debt funds?
Arbitrage fund, yes. Equity savings fund, you have to make an informed choice. Equity savings fund is a mix of equity and debt, and you are still vulnerable, or you are still exposed to greater volatility of the equity component, which is more than what you were used to in debt fund. In case of arbitrage fund, it is very attractive. I think individual investors should no longer invest in a liquid fund, because liquid fund doesn't make sense. But even earlier it didn't make sense. If you have to invest in something which is of short-term nature, and you want to actually reduce your tax liability, because when you invest in an arbitrage fund, the nature of the investment, the nature of the return that you derive from an arbitrage fund is like that of fixed income. It never goes ballistic. It is completely insulated from the volatility of the equity market. These arbitrage funds are managed in a manner that they are able to give you a kind of return which is very much in line with the prevailing interest rates. From tax point of view, the return is treated as equity income. And if it is an equity income, then if you hold it for less than 1 year, it will be taxed at 15% flat, short-term capital gains. More than 1 year, 10% capital gains.
Okay, so arbitrage funds would be better.
Will be attractive. Equity saving fund is very attractive for a conservative investor. And think of an investor who want to invest substantially into fixed income and nominally into equity. Say 2/3 of your income is invested in fixed income. 1/3 of your money is invested in equity, and you have invested in two funds. In one fund you have invested 66,000, in another fund you have invested 33,000, a lakh of rupees invested. If you have done these two things, one will be treated as equity, one will be treated as debt, and the debt one will not be indexed. If you mix it, it will be eligible for indexation. It will not be treated as equity. It will not be treated as debt. It will be eligible for indexation. So mixing it up might be beneficial. Not only that, the basic benefit that you are not liable to pay taxes till you realize it even continues.
Okay. Now, what about international funds? Should one consider them? Should one continue investing in international funds?
As I keep saying that, as in case of debt fund, that the primary reason why you invest in debt fund is the reason why you should invest in a debt fund. You should invest in international fund for the reason one should be investing in international fund. Two benefits. One is that you get their promising portfolios, and then they are it's a meaningful diversification. Likewise in debt, you invest in debt because you want stability in your portfolio, and you need your money in near future. So international fund is a meaningful addition, but not availing indexation and not being treated as equity is a huge disadvantage, and it doesn't happen anywhere else in the world. And there is a vehicle available. You can open a brokerage account with any of the overseas broker, any of the foreign brokers in India, and you can buy any of these index funds, and you buy them directly and they will be eligible for indexation. So you have a way of achieving that. Besides that, there are other vehicles which are coming in. The Gift City account of National Stock Exchange and BSE will be enabling a mechanism whereby you can invest in foreign equities with greater ease, and it will be, it will qualify for indexation. So you can, in the international fund, which were a very simple vehicle, you invested the way you invested in any fund, and you were able to invest your money abroad with great simplicity. That simplicity is gone. But if you are serious about it, you have a vehicle. Besides that, there is another vehicle which remains simple. There are equity funds which invest a part of its money, up to 35% of its money, into international stock. So if you invest in those funds, you are getting that exposure without the bother.
Yeah, right. Now, after all of this, in which taxation bracket do the balanced advantage funds fall?
Balanced advantage fund will treat it as equity fund, because that is how they are configured. They are 50% equity, 50% debt, but the 50% equity plus 25 to 30% into arbitrage opportunity. Because the legal definition of an equity fund from a taxation point of view is average allocation of 65% and more in equity. To have 65% and more, they have 50% into equity and 15 to 18% into equity arbitrage. That makes it eligible for, so the character remains of a balanced fund. It is equally invested in equity and debt, but from a legal point of view, from a tax compliance point of view, they actually become equity fund.
Okay, by the looks of it and the way you've answered these questions, it looks like this is not the end of the world. Nothing too bad has happened after all, which is great news. So keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.